Hi, I'm Rick Kahler. Thanks for joining me. When it comes to investing, it's simply a losing proposition to try and be anything better than average. I was recently reminded of this important investing precept when I attended a presentation by Ken French, a noted professor of finance at Dartmouth College. The theory is institutions are smarter than dumb individuals and can add value, he said. That is simply not true. His research has found that institutions are no better at trying to beat the market than an individual investor is. When you pay someone to do better than the market, French told us that you should expect to lose. It's really hard to identify the great managers. You're wasting your time and money trying to beat the market. Now, those are some pretty strong words from a really wise professor. If there's no point in trying to beat the market through active investing, then what's the best way to invest? Through passive investing. Passive investing accepts average market returns. And to do this, you need to reduce your expenses, concentrate on that, diversify your portfolio into index funds of various asset classes, minimize taxes, and then exhibit a lot of discipline. Let's take a look at these. Number one, reduce expenses. Passive investing generally costs around 0.2% a year in fees. That's compared to around 1.35% for active investing. So passive investing usually will cost you 1% less than active investing. And 1% over a period of time is huge. Number two, diversify into index fund. Simply select an index in the asset classes you want to hold. The inherent strategy of the index will determine when to buy and sell. You don't need to make those decisions. For example, the inherent strategy of the S&P 500 is to own a fraction of the largest 500 companies in the U.S. Every June, those companies that fell out of the top 500 largest are sold, and those that made it into the top 500 are purchased. The third point is minimize taxes. The limited buying and selling of passive investing tends to reduce investment-related taxes. There's no need for you to buy and sell the mutual fund or do any type of timing. You can buy it and let it go because the index is going to take care of that. The fourth is to exhibit discipline. Relying on the inherent strategy of an index fund puts some distance between you and buying and selling decisions, making it easier to maintain your investment discipline during market fluctuations. Now, you might be thinking that if passive is the way to go, why not make things even simpler? Why not just put your retirement money in the bank and forget it? While you certainly can do that, the results may be disastrous. If you want more than just Social Security for your retirement, you need your money to grow, and your money is not going to grow in the bank. Consider this. In 1913, 9 cents bought a quart of milk. In 1963, the same 9 cents bought a small glass of milk. And in 2015, that 9 cents bought 7 tablespoons of milk. Clearly, putting money under the mattress, which is about what you're doing with money in the bank these days, it just doesn't work for the long term. The culprit of the declining purchasing power of that 9 cents is inflation. So the moral of this story is to make sure your money grows at least as fast as inflation. So to do that, it requires investing it. For example, $1 in 1926 would require $13 today to provide the equal purchasing power. So your dollar had to grow to at least 13 to still be a dollar. Had you put $1 in the bank in 1926, you actually would have $21 today, but that's before taxes. However, invested in long-term bonds, you would have 6 times more money, $132 for every dollar. And if you had invested in the S&P 500 index, which is stocks, you would have $5,386 for every dollar invested. That's what, about 40 times what you would have had investing in bonds. Now, does this mean that you should invest all of your retirement asset in stocks? Well, if you're 1 year old, yeah, you probably should do that. If you're 1 year old, you're not listening to this video. And if you are, you're really bored. But if you're 60 years old, probably not. For most of us, a mixture of index funds that includes a lot of asset classes, such as global stocks, global bonds, global real estate, and commodities. Doing that, having a mixture like that, is the best strategy. Research supports the value of a diversified portfolio and passive investing as a long-term strategy. According to a study by Dalbar Incorporated, average passive investors earn 3 to 4% more annually than average active investors. That's $30,000 to $40,000 more a year for every million. Over time, that makes a huge, huge difference. Thanks for listening.